Hello, everyone. Very good morning, good afternoon, good evening, as per your respective time zone. We'll just wait for a couple of more participants to join, and then we will start the session. We'll just wait for 2 minutes, guys, and then we'll start. Perfect, guys. So let's start our session. So first of all, a very good morning, good afternoon, good evening, as per your respective time zone. In this webinar, guys, we will be going to discuss about the risk-based internal auditing. So basically, I would be telling you that what is an RBIA, what is an importance of the RBIA, correct? How in an organizations we can implement the risk-based internal auditing approach. Okay. I'll also give you an example of a risk-based internal audit approach with the help of a case study, and then we will also see couple of templates which you can use in a risk-based internal audit. So all those things we are going to discuss in our today's webinar, guys. So let's start our webinar with the first. Let's just discuss about the importance of the risk-based internal audit. First, let's just discuss about what is a risk-based internal audit. So guys, let me just explain you that what is the meaning of the risk-based internal audit. See guys, when I say a risk-based internal audit, that means what? That the audit which you are performing, the traditional audit which you are performing, now instead of that traditional audit, you would be doing a risk-based audit. Meanings of risk-based means what? That you would be focusing on the risk. What are the key risks of the organizations? So our focus will shift from the control to the risk. Now, how we do that? What are the objective of the RBIA? Let me just quickly discuss about that, guys. That what is an objective of RBIA and how this RBIA is different from the traditional approach of audit. So when I say a risk-based internal auditing approach, guys, in a risk-based internal audit approach, what is your main objective? Your main objective is basically to provide an assurance, a greater assurance to the board of directors. When you implement the risk-based internal audit approach, guys, in that case, what will happen is that your board of director will get some higher assurance as compared to the normal audit process. How the board of director will get the greatest assurance, I'll explain you that with the help of the case studies as well. As of now, I am just explaining you the bullet points that what are the objective of the RBIA. As we discussed, guys, see, when we are doing a risk-based internal audit, so our focus will shift towards the risk. Okay. So as a part of this audit, we would be providing an assurance that whatever risk which are being identified by my risk team, or whatever risk that we have identified through our risk management framework, all those risks are within the acceptable limit. whatever the risk tolerance which is set by the a board of directors, we will be giving an assurance as an auditor that those risks are within that acceptable limit. Okay. And when you are doing a risk based audit, so guys, in a risk based audit there is a one very key terminology which is called as a RAU. RAU stands for Risk and Audit Universe. So when you would be doing a risk-based internal audit, at that time you need to prepare this document. Okay. I'll also show you the template, how the risk and audit universe will look like. I'll also tell you the approach that how this document will be prepared. Okay. And template also we will show you. Okay, guys. Now let me just quickly move to my discussion with respect to how can I implement RBIA in my organization. What will be the step-by-step process in order to implement the RBIA? So guys, let me tell you one thing very clearly. If you want to implement the RBIA in your organization, so first there has to be a very detailed ERM in your organization. When I say a ERM stands for Enterprise Risk Management, because the first step of the implementations of the RBIA is what we need to assess the risk maturity of the organization. Before you start the RBIA, what you need to do, guys, you need to assess the risk maturity of the organization. You need to figure out that from the risk management perspective, where are we standing as of now? So basically what we do is, when we complete this assessment, guys, so we basically will categorize our organization, that in terms of risk management, where are we standing as of now? Whether our organization is risk navy. Okay, that means as of now we don't have any risk management approach. So this is a maturity level, I would say maturity level 1 in terms of enterprise risk management. Risk aware, when your risks are scattered. As of now, you don't have a consolidated risk register. Okay, risks are identified within the functions and not across the processes. So when you are standing at this level 1 or level 2, at that time what we generally do is we follow the traditional audit approach. See, when your organization's risk maturity level is this, risk aware and risk navy, in that case you cannot go for the RBIA. What I am telling you is, in order to implement the RBIA, first organizations risk management, enterprise risk management should be at level this, which is your level 4 and level 5. Level 4 is risk managed and level 5 is risk enabled. When you are at this 2 level, then only you can implement the RBIA in the organization. So the first step here is what? First, we need to understand our enterprise risk management. And now how we will do that? So basically, we would be doing that with the help of, discussions with the management. We will be checking that what are our business objective, whether our organizations have defined the risk appetite or not. Now, this is also very important, guys. Risk appetite. Now, what is a risk appetite? Basically, any one of you guys, you might have heard about this term a lot, risk appetite. Do you know what is the meaning of the risk appetite? Any one of you?
The amount of risk
The amount of risk that organization is willing to pursue in order to achieve their business goals.
Okay. What about others, guys? What is a risk appetite?
Maximum risk the organization can take.
Tolerance, we can say.
No. See, so there are 3 statements, guys. Okay, let me just clarify those statements. One term is called as a risk appetite. Okay, risk appetite. Another term is called as a risk capacity. Okay, and one more term which is also called as a risk tolerance. See, all these three terms are different. Let me just explain you that with the help of example. See, when I say a risk capacity is basically the maximum amount of risk that your organization can take. They cannot go beyond capacity. If they go beyond capacity, then the organization's going concern will be affected. Risk appetite is basically the normal amount of risk that organization is willing to take. This is a normal amount of risk. And tolerance is basically what? Tolerance is basically a deviation from the appetite. Let me just explain you that with the help of example so that you can relate it to better. For example, guys, your normal risk appetite is how much? For example, you can eat up to one two small pizza. For example, this is your normal appetite. What is your normal appetite? You can eat up to two small pizza. That is a normal appetite of yours. But sometime when you go to the Domino's, when you go to the Pizza Hut and all, where the pizzas are very famous and all, very tasty, at that time you are ready to tolerate from your appetite. So at that time maybe you can have three small pizza. So tolerance is what, guys? It is a deviations from the appetite. And when I say a capacity is maximum. So for example, you cannot eat more than 4 small pizza. If you will eat more than 4 small pizza, then you will vomit. So basically that is called as a capacity, the maximum. We cannot go beyond the maximum. So what I'm trying to tell you here is that when you will say that my organization's risk maturity level is managed, or my organization's risk maturity level is risk enabled, it means that your organizations have already put in place the enterprise risk management framework. The ERM framework is very well defined in the organization. The risk appetite is very well defined for the entire business. Now, guys, see what happens is when you are defining a risk appetite will be different for organization as a whole. Okay. Risk appetite will be different for the business units, the divisions. Okay. It will be different for the specific categories of the risk. Correct? Sometimes what happens is people will assume that, okay, at my organization level, I will be having only one risk appetite. No, guys, this is not how it works. Risk appetite will be different for an overall business level. It will be different for suppose within a business, you have a different unit and division. You will be having that different. Sometimes you also define an appetite based on the risk, a specific risk. Okay. So when you are evaluating your enterprise risk management framework, when you are evaluating the risk maturity of the organization, these are the few factors that you need to consider. You will also be checking whether my organizations have defined the risk register or not. Okay, whether the risk register is defined or not, whether the risk register includes all the kind of a risk or not. Okay, so according to that, what you would be doing is you would be deciding, okay, that this is my organization's risk maturity level. Once this is assessed, then only you can adopt the RBIA. For example, if you are working in a company where they don't have an enterprise risk management framework, can you implement RBI as a whole? No, you cannot implement, because this is a basic requirement. In order to implement the RBIA, first there has to be an ERM. So guys, I'll tell you one more fact. See, when we say that I will be doing a risk-based internal audit, what does it mean? What does it mean? So guys, as an auditor, you would be providing an independent assurance to your board of director. What kind of an assurance you will be providing? You will be providing them the assurance that the risk management process which they have put in place, are operating as intended. So guys, as a part of risk-based internal audit, the auditors would be basically auditing the risk management process of the company. They would be evaluating that the risk response which they have highlighted, those risk response are adequate. Those risk response are adequately covering the risk which has been highlighted, and this risk response methodologies are implemented throughout the year. So what I am trying to tell you is that as a part of risk based internal audit, as an auditor, you would be commenting on the ERM, that how well the ERM was designed and how well the ERM is implemented, and whatever risk response methodology which we have highlighted, whether those risk response methodologies are working properly or not. Okay, so this is what we would be doing as a part of RBIA, which is your risk-based internal auditing. There are a couple of more elements to the RBIA, but this is the key element of the RBIA. Okay, guys. Now, what we would be doing, guys, let's just discuss the entire those concept with the help of some practical case study. As of now, I have given you too much of academical knowledge, correct? But let us just discuss that with the help of the case study, okay? So that we will be able to relate couple of more concept, okay, in a better way. So what I would be doing, guys, I would be opening one case study, one PDF document. You need to read that PDF document along with me, and then we will be discussing that in that case, how your traditional audit approach will work and how the RBIA, which is a risk-based internal audit approach, will work. Okay, so we will be doing a discussions on a particular case study. So guys, please read this case study along with me. Okay, so there is a ABC bullion trading company which has a nationwide branches which sell the gold to the registered customer. So what is the nature of the business of this company? They are selling the gold to their registered customers. ABC is a consignment agent for a global bullion company, and principal delivers gold directly to the branch. Okay. Prior to taking the delivery, customer makes the advance payment of full amount. Remittance made to the principal usually a day after the gold sale date, and any loss on gain in the foreign exchange are debited and credited to the customer. There is a gold procedure manual. So guys, there is one document which prescribe basically how the entire workflow will be working in the company. So there is a procedural document for the same. And they also have a gold management system, which is a GMS. Okay. Head office has a real-time access to the branch transaction, as the GMS is an online. Because of the high value of the transaction, the high inherent risk of physical loss, and the board assurance requirement is very high. So let me just tell you about this as well. Board assurance requirement. So guys, see, whenever we are doing an audit, let me just reshare my screen. See, whenever we are doing the audit, so when it is an RBIA, basically a risk-based internal audit, so we also need to see that what is the expectations of the board of director. Whether the board of director assurance requirement is high, whether that is a medium, or whether that is a low. See, when the board of directors assurance requirement is very high, in that case, you cannot give the reasonable assurance. You know, as a part of traditional audit, what we do is we always say that we are providing a reasonable assurance. Correct? When the assurance requirement is high, in that case, we need to take that audit from the perspective of RBIA. In this case study also, I will show you the different approach, guys, how the traditional approach will work and how the RBIA approach will work. Okay, so I'm just giving you the perspective. Board assurance requirement can differ area to area. For example, since this is a critical part of the business, the assurance requirement of the board here is what? High. They want a high assurance. Okay. Now, during the third quarter of the year, one branch, an auditor have observed the discrepancy between the locker register balance and the GMS. So one is my gold management system, guys, and one I have a register. So some auditor have noted a discrepancy in both the data. Okay, then management took a view. While no gold was stolen, gold was being unofficially loaned to a certain customer. When this discrepancy was noted, then what the management have done is they have checked whether any gold was stolen or not. So they noted that gold was not stolen, it was loaned to a certain customer. Other practices also favoring a customer at a cost of the company also came into the light. Management came to the view that branch manager was unaware about this wrongdoing. The manager was not aware about this because manager was also doing the physical verification on a fortnightly basis, and he was telling the balance with the GMS. So he didn't encountered any such discrepancies on the day when he was doing the reconciliation. Okay. So this is basically the case study. The management has become a worry and wants to know the internal auditor of the other branch on the quality of their assurance. So now management was also want that, okay, all other branch, whether you have also noted such kind of a discrepancy. So now let's talk about a one branch which is at Agra. So in a Agra branch, what happened is one officer was trained on the GMS. So GMS is my system, gold management system. And in that one officer was trained. What that personnel was be doing is he was the one who was passing the entry to the GMS. During the year, officer went for a 2 weeks leave. As the branch manager didn't know how to use the GMS, he made a manual entries while carrying out the transaction. So no entry were passed into the GMS since the person was on a leave. And apart from that person, nobody else know how to use the GMS. On the return of the officer regularized the transactions by passing the entry into the GMS and took the receipt signature from the customer. Once again of the gold deliver on the printout of the electronical delivery note. So once that person has came back, he has passed all the transactions in the EDA. Now this is the case study. Now in this case, guys, how we would be processing this particular case as per the traditional audit approach. First we are discussing that, and then we'll also see how we would be processing this case as per the RBIA. So let me just show you. Now, as a part of traditional internal audit methodology, what was happening, guys? So internal auditor was doing the audit every quarter. They were doing a quarterly visit. As of now, they have not found any significant observation in their sample depth check. So when you are doing a traditional internal audit, you are doing your sampling. In a sampling, you have not found any discrepancies. Okay. One of their report did mention that the GMS was not used for the fortnight basis. The same which we have discussed above. Since the person was on a leave, the GMS was not used on a fortnight basis. So that was highlighted in the traditional audit report. As the concerned officer was on a leave, 50% of the audit sample for the quarter included the transactions during the period. Like whatever transaction that has been occurred during the period, in those transactions, no discrepancies were observed. So guys, one thing which I want to highlight, see, when you are doing a transactional internal audit, your focus was more on the transactions. How many transactions, that in transaction, whether the process was followed or not, whether my whatever procedure that is written in my manual, whether that was followed or not. So we focus on those aspects when we are doing a traditional audit. In the response to the management's year-end query, the internal auditor replied that their assurance was based on their sample size. See, management has asked that I have a high assurance requirement. Then auditor has reverted that was my assurance was based on the sample that I took. And I am giving you the limited assurance. I am not giving you the high assurance. Okay, I am giving you the limited assurance based on my sample review. Okay, the procedure involved the cross reconciliation, including the quantitative reconciliations of the goal for the year. So this is a traditional audit approach where what I'm trying to tell you here, you have focused more on the transactional aspect. Here you have focused more on the checking, okay, my procedural manual was followed or not followed. So that is what you did in the traditional internal audit. Now let's discuss about the same scenario in the RBIA methodology, risk-based internal audit methodology. So guys, as I told you, see, whenever you would be doing an audit as per the RBIA, first you would be checking the organization's risk maturity level. You would be asking the organization, have you done the risk assessment? Okay, have you done the risk assessment? Organization, if they have done the risk assessment, they will be showing you that risk assessment. If they have not done the risk assessment, then they will tell you that no such risk assessment was done. Okay, so they will tell you that. Now, suppose if the organization have not done the risk assessment, then as an auditor, first what I would be doing is, first I would asking the organization to do the risk assessment. Okay, first I would be asking the organization to do the risk assessment. Now, in this case, sometime what will happen is, sometime the organization may give the responsibility to the auditor with respect to, giving the consultancy services to promote the RBIA. Okay, now what is this, guys? Let me just explain you that here. One more important thing with respect to the RBIA. Okay, so for example, guys, in a RBIA, basically what will happen is, okay, there are two elements. One would be what you would be, working as an auditor, and you will be giving your assurance whether the my enterprise risk management process is working uh, throughout the year, and whatever the risk we have identified, the risk response methodologies are able to mitigate that risk. So that is a normal assurance that you are providing as a part of RBIA. Correct? Normal assurance. Now, second element in the RBIA is what? Sometime as an auditor, you would be doing the consulting services. See, you will not develop the risk register because you are an auditor. Okay, you will not develop the risk register, but what you would be doing is, you would be providing a consultancy services to perform the risk management. So here there is a one term which is called as a PGF. What is the meaning of the PGF, guys? So PGF stands for promoting, okay, promoting, guiding, and facilitating. So basically, guys, as an auditor, you would be promoting an organization and guiding them and facilitating them to implement the ERM in the organization. Okay, and you will be helping them to identify the improvement as well. Okay, so now suppose when you have asked the organization, have you done the risk maturity assessment? CFO have replied that risk committee has been constituted 2 years ago that meet on a quarterly basis. The risk management policy is also there. Okay, in every meeting we are reviewing the strategy risk. The current status report of the board through the audit committee with respect to the bullion, a reference was made to a gold procedurals manual. So there was a manual which described the length of the workflow and the related control. GMS has a no deviations compliance level throughout the company as the risk appetite of the bullion was 0. So basically, guys, for this particular process, their risk appetite is 0, since this is a very critical process. Organization cannot afford any risk in this process, so they have set their appetite for this process as a 0. Okay, now the branch internal auditor wrote back and had visited the branch and had obtained all the understanding of their GMS system and the control therein. which was he thought were impressive. However, he wanted to know whether the risk that this controls aimed to remove were identified, assessed, documented, and updated periodically. Based on the dialogue with the concerned person, the branch internal auditor observed that there was no enterprise-wide, continuous, and consistent structure activity relating to risk, but occasional discussions on a risk followed by letter to the particular branch. Now, guys, here is the point. Now, what we are concluding that as of now, see, organizations has everything in terms of they have a risk management policy, they have a committee is meeting on a periodical basis. I have a gold procedure manual which describe the controls as well. I have set my risk appetite, which is a 0, but I don't have a consolidated risk register which will tell me that, okay, what are the risks associated with this process and what are the risk response to mitigate that risk. So as of now, it is not there. So when as an auditor, they have asked me to do an RBIA, first I have assessed their maturity. And after assessing their maturity, I have concluded that as of now, the organization's maturity was what? They are standing here. Where they are standing? They are standing here. Risk aware, which means they have a scattered process. Correct, guys? They have a scattered risk management approach. Risks are identified within the functions and not across the processes. And it is not communicated across the enterprise. So I have concluded that. Then I have given a recommendation to have a risk management framework in place. Most important recommendation I have given them, that was maintain a risk register. Okay, and regarding the internal audit report, the branch internal auditor concluded that he had given only the assurance on the compliance of internal control as per the gold procedural manual. So in the traditional audit approach, the auditor has only given assurance that I have checked the compliance of control as per the manual. I have not focused on the risk. Correct, guys? I have not focused on the risk. I have not conducted my audit as per the RBIA. Okay. The high assurance requirement of the board, as there were too many transactions during the year, and as per the traditional audit methodology, he could give the reasonable assurance on the control. Now, so when the auditor have done this first level of review, has given all the recommendation, now in the next audit committee, all these recommendations are being discussed. Okay, the general view of the director was that the assurance requirement of board was high, that this was the process where the assurance requirement was high. And the audit report was only giving the reasonable assurance about the control being followed. So hence, what the management have done is, management have started developing their risk management, risk register. They have started a process of identification, assessment, and documenting the response of that particular process. Now, guys, what happened is, now I'll just show you the related documentations as well with respect to this. So, for example, guys, based on your recommendation, what management have done, guys? See, management have formed their risk register. That this is my risk register. Okay, in this risk register, we were discussing about that process of selling a gold. So this is the process, this is the sub process, this is the process owner, this is the risk associated with each the process. Okay, for example, I am selling a gold, so there may be a new buyer or novice buyer of the gold bar. So what is the risk in this process? Messy dealing, time wastage of a staff, as company doesn't sell less than a gold bar because they are dealing in the bullion, they are dealing in the bars, so they will not sell the less than a bar. Correct? So this they have identified. Now against that risk, obviously there would be some controls also. So they have mapped the controls as well, that we would be giving the orders only to the registered customer. So what I am trying to tell you is that management have started documenting the risk register, where they have documented each the process, risk against each the processes, and the consequences then the risk assessment in terms of impact likelihood. Correct. Then once this is identified, they have implemented the control. This is my inherent risk. And after implementing the control, I have also calculated the residual risk. Correct. So now the management have completed their work. Okay. Whatever recommendation that you have given, the management have completed the work. Now suppose you have to initiate the risk-based internal audit here. Correct. Now what will you be doing? Now what will you be doing? So now guys, you will be preparing a RAU. Suppose if the risk register is there in the organization, okay, and you have to follow the risk-based internal audit approach, then you as an auditor, what you would be doing is you would be preparing an RAU. Okay guys, do you know what is the meaning of RAU? Any one of you? Do you know what is the meaning of RAU?
Risk
Assessable unit.
Sorry?
Risk audit universe.
Risk and
Audit
audit
universe.
universe. Guys, now what I would be doing is, now I would be preparing a risk and audit universe for this company. Once I have the risk register, then what I would be doing is I would be reviewing basically that risk register. I would be checking their methodology, like how the risks are being identified, what are the inherent risks. Then from that risk, I would be identifying the auditable units. Okay, let me just show you a real life example of a risk and audit universe. So for example, whatever risk that management have highlighted, whatever risk that they have highlighted, I have written down their consequences. I have noted down their impact, likelihood and all. And accordingly, I have, mapped the controls against those risks which was being highlighted. And most important thing is what I would be identifying the auditable unit, that, okay, this particular risk can be controlled in which audit, in which process I can cover that risk. Okay, let me just show you the example. For example, let me just also show you. So I have two templates for RAU, risk and audit universe. I will show you both of those templates so that you can relate it to better. So for example, guys, this is my RAU. So what I have done is that whatever risk and controls that management have identified, first you would be reviewing. You would be basically first concluding whether to rely on that risk register or not. Is there any risk which were not being properly identified or not being properly documented? Suppose when you go through the manual, when you go through the process walkthroughs and all, if you feel that there are few risks which may not be added, you can always add those as a part of your RAIU. But the base for the RAIU would be what? The risk register which was prepared by the organization. Then you would be writing the audit procedures against each of that risk. What are you going to check and how are you going to check? Those audit procedures also you would be writing one by one. Okay, then basically what you can do is you can then define the periodicity of that. You can define the outcome of the previous audit, and you can define the overall risk grading. Correct. So this is what you can do basically as a part of this RBIA methodology. Now what you would be doing is you would be doing that audit based on an RBIA. Now suppose when you have did this audit as per the RBIA, you have noted the instances of non-uses of GMS which was already identified in the traditional audit as well. Correct. A GMS is an online a comment was made on the weakness of the monitoring control. Now when you did an audit as per the RBIA, you have also commented on the monitoring control at a head office level. What weakness you have identified? You have identified a weakness. For example, suppose if any branch is not using a GMS or any branch is not using an electronical delivery note, that has to be immediately flagged by the head office. Okay, they should not wait for a a branch auditor, branch head to do an audit of a fortnightly basis, or suppose they should not wait for an auditor to come at a quarter end and then auditor will flag. Instead of that, we have identified a weakness that suppose if the electronical delivery note is not being prepared, then immediately the head office will be asking the branch that why electronical delivery note was not prepared. Correct? So you have identified that this has to be an automated process. Another actions which you have identified is what you have asked the management to train more than one person to use the GMS. Okay. Now, just to summarize our case study, guys, what we have done is, for example, guys, when we have done the audit under the traditional audit methodology, in that case, see, does the branch management feel the responsible for thinking about the risk that could impact the objective? No. Correct? If there is a risk-based internal audit approach, then only organization will prepare the risk register, and then only the branch management will feel their responsibility about the risk. Correct? Their responsibility about verifying that there were no unofficial gold loan for the year gone by. Correct? The internal auditor will also form their opinion on the reliability of the process used by management to identify and assess the risk. See, when the RBIA will be followed, then only auditor will assume the responsibility to provide the opinion whether the risk management process or the risk response strategies which were identified, whether those were working effectively or not. And when the RBIA will be there, then only the auditor will be able to provide the high assurance, which was the ask of the board of directors. Correct? So this is basically about the RBIA, guys. Now, you might be having some of your queries or some of your doubt. So what you can do is you can raise your hand and you can ask your queries, guys. Yeah, tell me.
Hello.
Yeah.
Can you hear me?
Yeah, I can hear you. Please tell me.
Yeah. If it's a department, as you said, it would be the department who would maintain the risk register.
So basically, the maintenance of the risk register is done by the second line of defense in the company. Second line of defense in the company is what? The risk management team.
If the company do not have the risk management team or compliance team, then the first line.
So basically, see, that centralized risk register ideally has to be managed by the risk team only. If the risk team is not there, then it would be very difficult to prepare a consolidated inventory of all the risk. Then what you can do is maybe at a department level, they would be maintaining their risk register at an individual department level. But in that case, you cannot say that my organization's risk maturity level is risk managed or risk enabled, because this can be done only if you have a enterprise wide risk management. Correct? ERM. If ERM is not there, then the process, the LOD one, which is your process owner, they would be taking a responsibility. Okay.
Thank you.
Perfect. What about others, guys? Any query, any doubt with respect to the case study that we discussed? Guys, tell me. Yes, Mustafa, please tell me.
Sir, is there any template with respect to the case study that shows the ERM so that we can get an idea of how it is done?
Yeah. So I have shown you the ERM template now. See, for example, we have seen that ERM. So first, I have shown you the ERM only, the risk register. For example, this is the risk register. They have prepared this risk register for the process of selling the gold. Correct? Process, objective, critical, success factor, the likelihood, impact, the controls. Then they have formed a detailed risk register showing the inherent risk and showing after that they have mapped the control and they have calculated the residual risk as well. Correct? So if you will see, this is the format of the risk register, which was prepared by the organization. Correct?
Correct, sir. And sir, could you please shed some light how the rating is done for the impact and likelihoods?
Perfect. So for that, what they would be doing is they would be maintaining a matrix, a risk heat map. Correct? Where what they would be doing is they would be checking each the risk in terms of impact in terms of likelihood. What would be the impact of that risk and what would be the likelihood of that risk? For example, suppose any risk which has an impact of 4 and the likelihood of that occurrence is 3. That means your risk would be what? 12. So it will be categorized here. And in this risk heat map, you can also see, for example, this is an inherent risk severity. For example, in this, they have calculated this. This is an inherent risk 8, 16, 16, 16, 16, 16. Correct? So this is the inherent risk score. So they have first calculated the inherent risk, and after that, once the control is implemented, they have also calculated the residual risk after assessing the control. So basically, this we will be calculating with the help of risk heat map. Okay, where you need to assess the likelihood and the impact of each the risk. Likelihood and impact of each the risk. Clear?
Yes, sir. But sir, as you told that they are giving a number, like right, they give 4 to the major and 3 to the other side. So, sir, it means that they're quantifying in some way or the other. What would be the methodology for that? How they would be able to give some score? Like they are saying 4 is likely, but I can also give it to 5. That would be very subjective. So, what's the method of doing it?
So basically, there are two methods always, Mustafa. One would be the quantitative and another would be the qualitative. So when, for example, as an organization, you are assessing the likelihood, for example, in the first case, see, the risk register will always involve the subjectivity. You cannot eliminate the subjectivity. Correct? When you are doing that, you are doing a discussion with the process owner, for example, during the last year, how many such instances you have noted where the new customer were asking for example, gold chain? Because since we are dealing only on the bars, this risk is related to the messy dealing and time wastage of the staff, as company doesn't sell the loss of goods. So for example, in order to assess the likelihood, you will be discussing this with the process owner. Okay, tell me what number of instances you come across, correct? How many such cases were occurred during last 1 month and all. So there will be always a subjectivity which you cannot eliminate. This is something which you need to decide based on the past transaction history, maybe based on the what kind of situations can occur, cannot occur, correct? So we would be deciding that basically based on a lot of factors, like an internal factors and the external factors basically, and subjectivity will always be there. That is what I can say. Okay.
Thank you, sir. Thank you.
What about others, guys? Any query, any doubt here? Have you got an idea, guys? Yeah, please. Ahmed, please tell me. Sorry.
Yes, sir. Sir, as you told that, can you hear me, sir?
Yeah,
Hello?
I can hear you now. I can
Hello?
hear you now.
Yes, sir. Sir, as you told that if the management is not prepared, is not make the risk assessment, and as editor in a consulting role, if you perform that assessment, so is it not that after preparing that risk assessment, risk management, and you also do the audit of that, so it is a kind of self-review. Is it not that there is some conflicting between the advisory and audit?
No, come again. What is your, suppose the management have not conducted the risk assessment?
Yeah, and the management told you that, and the management told you that you should perform this risk assessment.
No, so we will not perform that. Basically, as I told you, We will not be performing that. We would be guiding them and we would be facilitating them in order to implement the risk management. See, as I told you, as an auditor, you will never prepare the risk register, because otherwise there will be a SOD violation. Very simple. Like, you cannot audit something which you have
Yes.
prepared. Correct. So you are
Okay.
absolutely right.
Got
We
it.
will not be implementing.
Okay.
What about
Thank you,
others,
sir.
guys?
Sachin, I have a question. How does the RCM come in this picture of RBA?
Sorry, how does RCM will come into the picture of RBIA? Correct.
Yeah.
So basically, see, guys, what happen is, when you would be doing an audit, you prepare your RCM. Now, for example, you might be thinking that, Sachin, in an RCM also, more or less, I talk about the risk, I talk about the risk consequences, and I talk about the controls. You are right. You are absolutely right. But see, preparing an RCM is a part of your audit procedure which you follow. Are you getting my point? The audit procedure which you are following now, in that audit procedure, what will be happening? You would be preparing that RCM maybe based on the limited process understanding, whatever is being provided to you by the process owner or by the business team, or based on whatever, suppose the manual or the policy document which you have gone through. Correct. So that RCM is prepared based on your understanding, whereas the risk register was prepared more from the organization standpoint of view. As I told you, for example, the management assurance requirement was high, so management have identified certain risk which I would be evaluating over and above. For example, in this risk register, there are suppose 10 risks. Okay. When you would be doing an RBIA, obviously you will check all that risk and all the risk responses against those. Over and above, if you feel that 2 more risks can be added, you can always add that into your RCM. Are you getting my point? See, the difference here is what the difference is. So in the beginning of the webinar itself, I told you that when we are doing an RBIA, we would be commenting on the ERM process, that how well your ERM are working, whatever risk that you have identified, whether those risk responses are appropriately implemented, whether those risk, for example, after the implementing the control, you have calculated a residual risk. So whether that residual risk is correctly calculated or not, that is what we try to assess with the help of RBM. Okay.
Okay, so Sachin, that means that in the RBA, in the risk-based IT audit, you have to first have you understand the ERM if it is available, understand if the organization has the risk register. Then after you have understood the risk function, then when you
prepare RAU.
Okay, then you prepare the RAU to identify the high risk areas you're going to audit, right?
Perfect. And
after that, then you can do the RCM.
Those RAU will be then catered into the audit group. See, in this case, since I have given you only example of a single process, now you think that, for example, you are a head of internal audit of a particular company, and you need to prepare an RA. See, RAU is what? Universe, risk audit universe. So this will be prepared at an organization level. Are you getting my point? So for example, in the risk register, if there are 100 risks or if there are 200 risks, so as a head of internal auditor, you would be reviewing that risk register and you will prepare a universe. And from that universe, you will try to map, okay, this risk I can cover in this audit. This risk I can cover in this audit. So you will try to map the audit table units to that risk. And then as and when you do that audit, you will ensure that risk, whatever this risk are being appropriately controlled, whatever risk response methodology that organization have defined, those are being appropriately implemented to mitigate the risk. So in a nutshell, this is what the main objective of RBIA. Okay, this is the main objective of the RBIA. There are a couple of few more elements in the RBIA which also I want to discuss. So guys, as a part of RBIA, see this your risk and audit universe. This risk and audit universe also needs to be reviewed on a periodical basis. Okay, for example, as and when there are changes into the suppose risk factors, changes into the regulatory requirement, and suppose if there are any new risk which has been arised due to change into the regulatory requirement and all, so you needed to include that into your risk and audit universe. Okay, so you need to regularly review that, and then based on that RAU, based on this RAU, what you will be doing is you will be preparing your audit plan. Correct, guys? Whatever audit plan that you prepare for an audit that needs to be conducted on an annual basis, so that plan will be drawn from the RAU only. Are you getting my point? Okay, so then once the plan is drawn from the RAU, then basically you will apply your normal audit methodologies which you follow, and this is how you would be doing the audits. Okay, clear? Yeah, Mohammed, please tell me. Someone have raised a hand, guys. Any query, any doubt? Any query, any doubt, guys? Yeah, feel free to discuss, guys. See, my entire objective of having this session is what? To provide you the practical understanding. Okay, because what is happening for an RBIA, like different people are using different understanding with respect to RBI. So I just wanted to give you the clarity. So feel free to ask whatever queries or doubts you have, please. Mohammed.
Yes, please. I need that to give us like calculate how to calculate the residual risk.
So residual risk will be calculated inherent risk minus controlled risk. Okay, so this is your inherent risk. In the inherent risk, for example, you have implemented the control. After implementing the control, whatever risk that remains is called as a residual risk. Okay. Risk which remains after applying the control is a residual risk. And in the risk heat map also, when you would be giving that score and all, that will be calculated risk. Okay. Yeah, someone have raised the hand. Mithilesh.
Yeah, hello.
Yeah.
Am I
Yeah, please.
audible?
You are audible. Please.
Yeah, actually, as you shown that the as per the maturity of the organization, risk maturity of the organization, if the organization's maturity on the third from the top,
Perfect.
Okay, so that means the company has their policy procedures but don't have the risk register, right?
Perfect. Doesn't have
When
a
we
centralized risk register. You are right.
exactly. But when we are doing the internal audit, sometimes they ask me, okay, so you can prepare for the risk register for me. For as you have you discussed one point,
We will be
PDF.
preparing an RCM. See, RCM is a different from the risk register. Correct. As an auditor, what you would be doing is you would be preparing the RCM. RCM and risk register both are different documents. Correct.
Okay.
Those are not. This document is owned by second LOD, and RCM is owned by third LOD. See, when you are at the third LOD, objective of the RBIA is what? You are providing an assurance to the management that your ERM is working.
Yeah.
Are you getting my point?
Yeah.
Correct.
No,
So basically, in short, you are basically auditing the second line of defense as well.
So sometimes what happens when the organization hire to the third party company to do the internal audit,
Perfect.
at that moment they offer it's okay, it's not a prepared at my
You
organization
prepare
level.
RCM, yeah.
Yes, they ask me to the prepare do. So
Perfect.
that moment, how we will prepare that document for that organizations.
You can prepare the RCM based on the process understanding. See, preparations of an RCM is also a part of your audit procedure. For example, if you ask me to prepare an RCM of your organization, how will I prepare that RCM? I'll quickly show you that also so that you will get some better clarity. For example, see the difference, format difference between the RCM and the risk register. You will get much more clarity. So, see, this is the comprehensive RCM. See, in an RCM, you know the process, sub-process, risk description, inherent risk rating, residual risk rating, operational risk category, control, the type of the control, priority, control frequency, detailed test plan, conclusions, then how much populations, whether I've done a population testing, sample testing, what are my sample size, population size, observation. So now let me just one by one tell you the difference. So for example, see, when the risk register was prepared, the focus of the risk register was basically to, first documenting the risk, then the risk consequences as well, then doing a detailed assessment in terms of impact and the likelihood. With the help of impact and the likelihood, first we calculated the inherent risk. Correct. Whereas in an RCM, as an auditor, I would be more focusing on the risk, what I have noted based on the process understanding. Then against that risk, what the control is implemented, and then whether that control was preventive, detective, effective, not effective. Correct. Whether I've done the population testing, sample testing. So both document are being prepared with the different objectives. There are a lot of similarities as well. I'm not denying that. There are a lot of similarities as well. But when you are doing an audit, guys, what happens is your focus is different, correct, from an auditor's perspective. And when someone is preparing an RCM, he is preparing more from the holistic approach, where his entire objective to see all the risks which are being associated with that process. So both the things are a bit different basically, and those are done by the separate line of business as well. Okay.
Yes.
Okay, perfect. Now someone is asking me, what are the obstacles in implementing the RBIA? Before I discuss any other query, any other doubt? Any other query?
Okay, Sachin, my understanding, this is my last opinion on this. So the risk and audit, the RIAU, right, is composed of two components. It's composed of the risk universe and also the audit universe. So the risk universe is for the risks, high risks, and then plus the audit universe is for the processes that you're going to audit. So what it helps us is, as auditors, is to identify all the processes that are high risks, the risks that are in those processes, then helps the auditor to plan what is going to be done in the RCM. Am I right?
Perfect.
Okay, thank you.
Now let me just take up this as well. So guys, when I talk about some of the obstacles or some of the pitfalls in the RBIA, what are the common ones? So first is what, guys, you will not get a support from the process owner or even from the CEO or MDs or the management persons. For example, In a class itself, couple of people have talked about this, that Sachin, we are doing an audit and management are asking us only that can you prepare the RCF. So that is the biggest, I would say, the pitfall. You doesn't get a support from the process owner or the KMPs of a company. There are because there are not a clarity. What they think is RBI risk-based internal audit approach is only the job of internal auditor. No, correct. It is not only the job of internal auditor. We will require support from the management as well. Correct. So this is one. Second, what I would say is that sometimes there are communications gap between the auditors and auditees. So auditors are not able to communicate well with them that in an RBIA, how the objective differs. So for example, in that example we have seen, when we were doing an RBI, our entire objective was shift towards the risk. Rather than checking the control, we focused our entire shift to risk. That okay, what are the risks? These are the critical risks. Okay, on against this risk, these controls are implemented. So let me just focus on that risk. Then let me just see, okay, that control was working effective, not effective. So that is also one thing, and then another, I would say that sometime what will happen is that the risk methodology or the risk heat map that is being prepared by an organization may not give you the true sense of the risk. Sometimes it is, just being prepared for the sake of doing a documentation. It was not actually discussed in a length with the process owner. So for example, suppose sometime when I'm reviewing a risk register and I feel that the risk, the residual risk or the inherent risk which was calculated as a part of this, suppose if that doesn't give me the appropriate picture, then I can always go to the management and ask them. I can tell my discrepancies in the same, and I can ask them to revisit the entire risk register, because that risk register doesn't giving me the confidence in terms of the current picture of the risk. So these are some of them which I can highlight. And apart from that, I think in this document also we have listed down certain this pitfalls in the RBIA. So you can also go through this. Okay. What we will be doing, guys, after this webinar, we'll also share you this document. Okay. So basically, to get this document, what you need to do is you just simply need to fill the feedback form. Okay. And once you fill the feedback form, we will be sharing you this document along with the template, the RAU template, which I've shown to you. Okay. All that document will also be shared with you once you complete your feedback form, and you will get the CP certificate as well. So yeah, now you can ask your query, Mithilesh.
No, I've already done. I've already discussed
Perfect.
with you.
Mustafa, anything?
Yes, sir. I have one question. Sir, as you mentioned that this would eventually lead towards an internal plan. So, sir, in the near future, would you be doing any session on it, or is there already a video uploaded on YouTube for it?
We can discuss that as well, where I can discuss the process to prepare that plan and the format of the plan. We can plan one more webinar on this.
Thank you, sir.
Yeah, perfect, guys. That is all from my side. Okay, one request with everyone. To get the CP certificate for the webinar, what you can quickly do is, guys, just use the link provided to you in the chat, fill the feedback form, and once you fill the feedback form, you will get the CP certificate. And also, to get an access to the document, you'll also get an email that how you can access this document. Perfect, guys. So that is all from my side. Anything else that you want to discuss? Okay, guys, thank you so much for your time. see you in some other webinar. And that is all from my side. Thank you so much. My contact detail I'll share you here in the chat. And what you can also do is you can also visit the website and you will find the contact details of my team. I am sharing you my number. Okay. Perfect, guys. That is all from my side. Thank you so much for your time. Bye bye. Take care.
Bye. Thank you. Good night.
Thank you so much, sir.
Thank you. Thank you.